I'm Ashley Martella for Newsmax TV Money. Joining me is David Frazier, editor of the monthly investment newsletter, the ETF Strategist. David, glad you could be here.
Nice to be here, Ashley.
Now, the big news is government action. Regulators recently took over California mortgage lender IndyMac. Now they stand ready to bail out federal mortgage banks Fannie Mae and Freddie Mac. Is this a bailout solution or simply a Band-Aid? What do you think?
Well, unfortunately, Ashley, it's another Band-Aid in my opinion. Over the past couple of decades, for some reason, the U.S. government has become more and more socialistic in their attitudes and thinking that they can resolve everyone's problems. They can't. Economic problems are best left alone to solve themselves. So what's going to happen when the government comes in and invests in the equity securities of Fannie Mae and Freddie Mac? How are they going to do that? Well, it's pretty simple, isn't it? They're either going to need to raise taxes or they're going to do some more government borrowing. So, gee, we want to increase consumers' taxes even more. We want to increase the budget deficit more. What's that going to do to the dollar? I can tell you what it's going to do. The dollar's probably going to resume its decline. So it's nothing more than a Band-Aid, and the bleeding is going to continue. The government needs to stay out of this.
Now, your monthly newsletter, the ETF Strategist, is focused on making money in any market, up or down. How has it done so far?
Well, overall, I think we've done a pretty good job. Before we get into any specifics, I think it's important to understand at first what are our objectives other than making money in an up and down market. And we run two model portfolios. One of those is a conservative portfolio. The other is an aggressive portfolio. What we strive to do with a conservative portfolio is to first and foremost to help investors preserve their capital. Our objective is not necessarily to return the biggest possible returns, but to not lose money. Since inception of the ETF Strategist last September through this past Friday's close, the conservative portfolio generated a return of 1.9%. Now that might not sound very good initially, but you have to keep in mind during the same period, the S&P 500 index has fallen 14.6%. So I think we've done a good job and have accomplished our objective. The aggressive portfolio has done significantly even better. That portfolio is meant for people that are both willing and able to sacrifice some volatility in the markets with the objective to significantly outperform a broadly diversified portfolio. Once again, as a benchmark, the S&P 500 is down 14.6% through last Friday's close. Our aggressive portfolio is up 11.6%. So it's beaten the S&P 500, that is a broadly diversified portfolio, by approximately 26 percentage points. You tell me, I think we've done a pretty good job.
Now, stock gurus like Jim Cramer of CNBC are calling on investors to get out. Do you agree with that?
Well, I've never paid much attention to so-called gurus like Mr. Cramer or a host of other gurus. What I can say is this: we've been telling our subscribers for many months now that the environment has remained very risky, and for the past several weeks we've been telling our subscribers that there's a good possibility that stocks could fall considerably lower from here. So I don't know if it's time to get out now. You should have gotten out weeks ago, if not months ago, and that's what we've done and have told our subscribers.
When stock markets fall, you tend to see mergers and acquisitions rise. In fact, a lot of big dollar dealers are making the headlines. Is this, in your view, a healthy sign or not?
Well, I don't think there's anything healthy about it. Let me ask you, let me answer in this way. If you're in a position that you're able to invest in a company at an extreme bargain price, would you take that opportunity? You probably would. Companies that get in trouble in environments that we're having now, where we're seeing an ongoing slowdown, their stock prices fall a lot. They fall a lot because their earnings go down a lot and the risk of failure increases. As a result, there's always big investors out there like a Warren Buffett or certain corporations that have lots of cash on hand that they're going to go in and they're going to try to buy out these kind of companies. So it's a positive for them. But for you and I, there's nothing healthy, if you will. There's nothing to suggest just because we're seeing M&A activity increase that stock prices in general may be at a bottom. So I'd say no, that don't read into that as being a healthy sign.
In terms of the ETF Strategist newsletter, what's your overall strategy for the rest of 2008?
Well, our strategy is what it always has been and what it will always will be. That is to remain flexible and to invest in those sectors of the market that show the greatest risk-reward characteristics. For example, we have a position in an oil and gas fund, an oil and gas ETF, that my models suggest will do quite well whether oil prices spikes significantly higher from here, I said spike, or spike significantly lower. We also have a position in a medical devices fund. My research clearly indicates, and I think most people can reason, that makers of medical devices are likely to do well not only this year but for many years to come. That fund, we've recommended a 30% allocation of that fund. It's virtually unchanged over the past few months, even though the stocks in general have fallen sharply. We expect it to continue to hold up well and to perform very well over the next couple of years. So in general, our strategy is to remain flexible and to look at those sectors that have the best risk-reward characteristics.
As always, David, thank you very much for your time and insight.
Sure. Thank you very much, Ashley.
And I'm Ashley Martello for Newsmax TV Money.